This is Jody Trana. Welcome to Chapter 3, Part 1 of Business Finance. As you can see from our list here, 4 of our 5 principles will be covered in this chapter. The only principle that isn't really applied in this chapter is principle number 2, there's a risk-return trade-off. Chapter 3 takes a look at the firm from the perspective of a financial analyst who's reviewing the firm's financial statements, including the income statement, the balance sheet, and the cash flow statement. The goal of corporate business is to maximize shareholder wealth. This is done by increasing profits, among other things. In this chapter, we're looking at the primary contributors to profits. That is assets and expenses. In business, we spend money on assets. Those are items that retain value for the sole purpose of making more profits. We should not be holding assets for any other reason. We also spend money on expenses. Those are the one-time costs that once we pay for them, they're generally gone. Expenses are also for the purpose of making profits. Assets and expenses are purchased or paid for to make profits, and we track these items on the financial statements. Assets show up on the balance sheet, and the expenses show up on the income statement. Profits show up as a monthly or a yearly figure on the income statement, and those profits are accumulated in the balance sheet as retained earnings. We're going to do a quick review of principles of accounting. In accounting, we learned that transactions, when they take place in business, need to be recorded in the accounting system. We record those through account categories and specific accounts. Those accounts are arranged into financial reports that we use for understanding how well the business is doing. The 5 primary account categories are assets, liabilities, equity, revenue, and expenses. Here we have a sample trial balance for a company. You can see here that the trial balance includes the account balances for all the financial activity. We still have them in order of assets, liabilities, equity, revenue, and expenses. Remember that the normal debit account balances show on the left side of a T account, and the credit balances show on the right side of a T account. Here in this trial balance, we can see that this company's trial balance is definitely in balance because the debit column equals the credit column. The next step in the accounting process is to take this trial balance and all of the account balances on it and distribute them into our financial reports. Let's start with the balance sheet. As I mentioned, the first 3 account categories on the trial balance are the assets, liabilities, and equity accounts. These balances are shown on a balance sheet. You can see here that our balance sheet does balance, and the reason it does is because I have added one account category called current year earnings. Let's see where we came up with that number. The last 2 categories in the trial balance are the revenue and the expenses. These 2 account categories are shown on an income statement. These columns won't balance because the revenue and expenses won't be the same. When your revenue is greater than expenses, you have a net profit, and when your expenses are greater than revenue, you have a net loss. Here you can see that our revenue is greater than expenses, and we have a net profit of $7,050. This $7,050 is transferred into our current year earnings shown on the balance sheet to make our balance sheet balance. Here's a sample income statement that came out of your book. It shows a pretty typical format for a corporate income statement. We first have sales, and then out of that we have deducted cost of goods sold to determine our gross profit. Gross profit is probably the most important profit number on the income statement because it's the number that is going to support your entire operations. After that, we have operating expenses, and those are often categorized as selling expenses, general and administrative expenses, and then depreciation and amortization. When we subtract all of the operating expenses, we get net operating income, also called EBIT, which is earnings before interest and taxes. And then you can see that we've also deducted those interest expense and income taxes to get our net income. Most corporate income statements will also have additional information at the bottom. Here we have dividends to be paid, the number of common shares outstanding, earnings per share, and dividends per share. Most corporate income statements are also reported in the millions so that they don't have all of the zeros on their statements. Taxes for both companies and individuals are calculated on a sliding scale. That is, we pay different rates of tax depending upon how much money is made, how much profit there is. This means that large corporations will pay 35% tax rates on their greatest amount of income, and smaller companies, those with before tax income up to $100,000 per year, are going to pay much less. For a company that makes $50,000, for example, their income taxes would be calculated as 15% of $50,000. But what if a company makes $75,000? Let's take a look. A company that makes $50,000 will pay 15% of that $50,000. But a company that pays $75,000 will calculate taxes first on that first $50,000 to come up with $7,500, and then they will calculate taxes on the next $25,000, which will be taxed at 25% for a total of $6,250. You'd add these two up and you'd get $13,750 of taxes due for a company that makes $75,000. How much tax is that? You can calculate the average tax rate by taking the total amount of tax liability that's due, the $13,750, and divide it by the total taxable income. That was $75,000 in this case. This company that makes $75,000 pays an average tax rate of 18.3%, which falls right between our 15% and our 25%. Here we have calculated taxes due for a company that has made $19 million in taxable income. How we do this is to take the total $19 million and allocate all of these funds based on the tax brackets that you see here. So the first $50,000 of the $19 million is charged a tax rate of 15% for total taxes due of $7,500 just on that first $50,000. Then we need to take the next tax bracket, which shows $25,000 due, and we calculate the taxes due on that amount of $6,250. We allocate all of the $19 million to each of these categories, and that final category at the bottom that says over $18,333,333, that category is our final category. All dollars that are over 18 million and such are taxed at a rate of 35%. So we calculate, we put the number in there that gets all of our numbers up to that $19 million taxable income that we have, and that final category is allocated an amount of $666,667. That final category and the number that we came up with will be charged at a rate of 35%. That's our final tax rate. Therefore, that $19 million of taxable income has generated taxes due of $6,650,000. If we want to calculate the average tax rate, we could take that $6,650,000 and divide it by $19 million. And we'll see that our average tax rate is 35%. At first glance, I have to admit that these tax brackets and the tax rates associated with them look a little bit random, but they are not. These brackets and the rates are designed so that any company that has income falling within the fifth bracket, that's the $335,000 to $10 million bracket, of that taxable income bracket will be charged an average tax rate of 34%. And any company that makes over $18,300,000 and change will be charged an average tax rate of 35%. It was intended that the corporations with the lower income would pay lower taxes. It's also intended that the companies with the lowest income, like those making under $50,000, would pay the lowest tax rates. That's why the tax rates start at 15%, but have larger rates like 39% and 38% brackets to get the averages up to that 34% and 35%. I'd like you to go ahead and try this exercise. You'll need to pause the video after you hear my instructions. With this activity, you are going to calculate the tax liability due for a firm that is reporting $100,000 of taxable income. So I want you to be able to fill out this table here. The first column is for the amount taxed, so how much is being taxed in each tax bracket. Then calculate the tax liability. That would be the amount taxed multiplied times the marginal tax rate. Then calculate the cumulative tax liability. That's each tax liability from each bracket added together. And then calculate the average tax rate for each tax bracket. Finally, I'd like you to tell me what the marginal tax rate is. Now remember that the marginal tax rate is the tax rate that they will pay on their very next dollar of income. So when they make $100,001, how much will the tax rate be on that extra $1? If you're not ready to see the answers, press pause. The final concept to prepare you for the assignments in Chapter 3, Part 1 is the concept of taxable dividend income. Remember that dividends are paid after a firm pays taxes? That means that a corporation, in essence, pays taxes on their dividend money before paying it out. When corporations own shares in another corporation and receive dividends, the corporation receiving the dividends has to pay taxes on those dividends too. It gets more complicated when the corporate shareholder is closely associated with the corporation that's paying out the dividends. When a corporation first pays taxes on dividends, and then the closely associated shareholder has to pay taxes on those same dividends received, it is called double taxation. To help avoid this double hit in taxes, there's a special provision to reduce taxes paid for corporate shareholders. If the corporation that receives dividends owns less than 20% of the corporation paying the dividends, then 70% of the dividend income is excluded. On $100,000, that would mean that $30,000 of that was taxable income. If the corporation receiving dividends owns 20 to 79% of the corporation paying those dividends, then 75% of the dividend income is excluded. If the corporation that's receiving dividends owns more than 80% of the corporation paying dividends, then all of the dividend income is excluded. This totally eliminates double taxation on these dividends. Here you'll see an example of one of the problems in your homework. I wanted to remind you that there are templates, Excel templates in Canvas for you to use. Those Excel templates are going to make it much easier as you progress through this course. You may, as you're beginning out, feel like, oh, I can just do this in my lab. I don't really need to use Excel. But you will find Excel very useful. I'd like you to give it a try now and start using the Excel templates now so that you become more comfortable and start using the equations very efficiently. So go check that out in Excel and use it for your assignments this week.